Hey, do we have sound? Yeah, we might. Good morning. Welcome to FX Street. FX Street. Trade Non-Farm Payrolls Live 199. OMG. Hang on, I gotta find the chat. Where'd my chat go? Oh, there it is. Yeah, we got sound. Testing. 1, 2, 3. Hey, 199 months in a row. Holy smokes, eh? Oh, for sure. That's legit, huh? Oh, where's my cappuccino? Hang on. It's over there. Hang on. Un momento, por favor. By the way, hey YouTube, this is royalty-free music. All right, now I gotta find where the music's coming from. Hey man, life's complicated. Hold on, relax. Why are you so angry? All right, hey, welcome to Trade Non 199. Yeah, that's almost 17 years of doing this at FX Street. That's pretty amazing. Next month, the last month of our year, will be the 200th month in a row. Isn't that amazing? So happy 199, everybody. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne McDonell. I am a currency trader just like you. About 20 years ago, just after the year 2000, I decided to quit my job as a venture capitalist and become a full-time foreign exchange trader. Let me tell you, that was a giant leap of faith. But like you, I had to make that decision. And boy, was that a big one. Because I'll be honest with you, I was quite happy doing what I was doing. I thought it was what I'd be doing the rest of my life. So it was a big deal to make the giant switcheroo and quit a firm that I helped grow from just a handful of people into 2 entire floors of a building right next to the San Francisco Federal Reserve Bank, by the way, right next door. I had a big giant office. I had a support staff. I had marketing people. It was great. It was cool coming to work. I even like walking to work from the parking lot. It was beautiful walking along the San Francisco waterfront every day. Just amazing. But my point is, I took a giant leap of faith. I left my career. I left a salary. I left retirement accounts. I left health benefits. Became a full-time Forex trader. And the one thing I hadn't planned over my 2 years of making the decision, one thing I hadn't planned for is the isolation of being a trader that traded from 10 o'clock at night to 10 o'clock in the morning. Have you guys run into that? The isolation is a killer, isn't it? And back then, there were no other Forex traders. I knew a lot of professional investors, but I didn't know any Forex traders. Never seen one, never heard of one. There were no conferences to go to. There were no webinars because webinars hadn't been invented yet. You couldn't go to Amazon.com because Amazon.com hadn't been invented yet. You can go to a bookstore called Barnes & Noble, and they had a book called Forex Made Easy. Anybody buy that? I think Forex Made Easy was something like $5,000, and what it did is it drew the MACD for you. How would you like to pay $5,000 for a MACD? So that's where I started. But I did some Googling because I was teaching myself how to trade. There was no books, no places to go. And I searched this thing called the internet. Back then, people even called it the internet. And I'm like, the internet? No, the internet. And internet is different. So anyways, I ran into this website, a brand new website for a niche market, and it was called FXStreet. So thank you to FXStreet for being here for so long, providing so much value to our community. Thank you, FXStreet. Okay. Steve, we're in our third hour already, but thank you for showing up. Better late than never, Steve. All right. So, what are we going to do today? Well, I believe we're going to talk about technical analysis and fundamental analysis. Okay. So, yes, over 20 years, I've learned a few things about technical analysis. So I'm willing to share different strategies, different setups, different ways of analyzing the market. Also have a macroeconomics degree from Harvard. Yep. A couple of degrees, actually. I studied cryptocurrencies with Gary Gensler at MIT. Before that, he ran the National Futures Association, which regulates the Forex business. So he ran the NFA. Then he taught a cryptocurrency course at MIT, which I attended. I was a student. And then when the course was over, he was hired to run the Securities and Exchange Commission and is now looking into the regulatory compliance for cryptocurrencies. So in that little tiny window, I got to know the guy that's in charge of the entire financial system of the United States. That's pretty, how about that? And I also studied algorithmic programming at a little university in England called Oxford. Yep. So anyway, fair game, you can ask different questions, and I'm happy to help. Let me know how I can help. I'm your servant. I serve you. Is anybody here new? Is this your first or second webinar with me? Most people here, I believe I've known a bajillion years. Okay. Oh, hang on. I got something. Okay. Anybody new? Any newbies? Oh, nice to meet you. Welcome. Please let me know how it can help. We can talk about, for example, the importance of non-farm payrolls or what non-farm payrolls is. Okay. Steve said, hey, I took my first weekly swing trade last week on Brent and you just hit your profit last night. Hey, bravo. Oh, we have a newbie? Yeah, okay. So we can talk about this chart we're looking at. What do we see here? This is a simplified version of a chart. Yeah, it's not my typical setup. I'm trying to simplify things as much as possible because it's easy to add layers of complexity. But we're not trying to we're not trying to look smart. We're just trying to make money. Okay. So if I'd love to dumb things down as much as possible. This is a great Aussie dollar dumbed down type chart. Now I have a ribbon of moving averages on this daily chart. And the moving averages are just the distance between a 21 EMA and a 55 EMA. The orange or red lines are closer to the 21. The blue lines are closer to the 55, and they kind of meet in the middle. But the fastest is the 21, the slowest is the 55, and everything else is just in between. And it's like a guide. And I have a general rules of engagement to keep me safe, to keep me organized. Well, here's a question. What time frame is best? They're all important. So right off the bat, we just solved a major problem. If you're asking, like, should you use a 15-minute chart or an hourly chart or a 5-minute chart? Well, the real answer is yes. So we can go through that today. We call that fractal geometry. The nice part about much of technical analysis is it works on all time frames, and that's what fractal geometry means. A fractal, right? What this daily chart will have very similar patterns as a 15-minute chart, and you would trade them the same. But here's where things start. I wrote a book back in 2008, or I wrote it in 2006 and 2007. It was published in 2008, called Strategic and Tactical Forex Trading. And it gives you a sense of how I set things up. You start with strategy. The first question with strategy is the market bullish or is the market bearish? Doesn't take account, looking at a chart here, we're not taking into account the fundamentals. And if you don't understand fundamental analysis and macroeconomics and central banking policy, then all you have is a chart. So let's start with this idea, okay, for all the newbies. If you were looking at this ribbon of moving averages, would you say it's bullish or bearish right now? Remember, I'm not talking about your opinion. I don't want your opinion. Everybody's got an opinion and they all stink. So if you were just an algorithm, how would you read this chart? Just one that says, hey, bearish indeed. Anybody else? Any other noobs want to chime in? Please let me know. Bearish, yeah. So under no circumstances on a smaller time frame would you buy this. You've made a strategic decision, and I'm assuming as long as you're below the moving averages, you're a seller. Okay. Now you might say, oh, but Wayne, it's going to make a hard... No, shh. You're trying to outsmart the market. Okay? And that's not the goal. You're not smarter than the market, and you're not going to make it. Okay? Terry says, hey, does your Forex Bootcamp include classes on fundamentals? There's, let me show you. Hang on. Let me move this over. So you go under, so this is inside, right? This is the membership area. You go in here to the training courses. Okay, there's 89 courses, 89 lessons. They're probably on average an hour each. So it's no joke. So the question, what about fundamentals? Okay, there's a central banking fundamentals course that has 2 pages. Okay, so about 12 to 15 hours of lessons on monetary policy. Okay, so by the third hour, you're learning how to manage the balance sheet of a commercial bank. Because if you don't understand how a commercial bank works, how could you understand what a central bank does and how that works? Okay, so that's the level of detail you're going to learn. In 3 hours after joining, you will be learning how to run a commercial bank like JP Morgan. Okay. The second one that you would get is macroeconomic principles. And a lot of these lectures are based on some of the studies that I did at Harvard on macroeconomics. So there's a little bit of review of money supply, but that you learn in the other course, but you kind of need that depending on the order you take the course. But you're learning like the solo growth model and some other really important things. Like, let's just pick on this one. Okay. So like here you're learning about the level of depreciation. So if you look at an economy, you want to look at the level of investment that is put into the economy. So there's a formula, right? Savings is equal to investment. Okay? Because when you save money in a bank, money in the bank gets deployed throughout the economy. Okay? So you save money, your bank pays you a little bit of interest, and the bank redeploys that capital. So they solve the asymmetric information problem, which means they go out and they get applicants. People go to the bank and say, will you lend me money for my business? Will you lend me money for a mortgage? And the bank is an expert at analyzing the risks and making wise investments, or at least that's the idea. And then they take your money, okay, and they turn that into an investment via a loan vehicle, right? So, if you save, that savings becomes an investment and the economy grows. But what we're talking about here is your investment level for the economy should be greater than the level of depreciation. And that's the challenge that mature markets like the United States have, where it already has airports, it already has ports, it already has airports, it already has public transportation, it already has bridges, it already has all this stuff. So if your economy is broke and people in the economy stop saving because they don't have any money, investment falls, and it falls below depreciation, and all of a sudden depreciation becomes greater than investment, and all your bridges and roads and ports wear out. It's kind of like Venezuela not investing profits from oil into the oil development infrastructure, the oil production infrastructure. So they take the money and they build soccer stadiums and palaces for the rich elite, but they don't take any of the money and reinvest it back into the oil production facilities. So what happens over 20 or 30 years? Your tools are broken and obsolete and inefficient. And eventually your production falls and you're no longer rich. So we discuss like all kinds of amazing aspects of economics, but you would use this information to compare different economies for potential investment opportunities.
And it has a built-in steamer, so you have crispy crust. And they're like, nice. Okay? And you'll see, boom, all of a sudden their productivity has gone up. Same baker, you've just gave them better capital. Then you give them more capital and say, hey, well, you got the first oven full. Why don't we fill the second one? Okay? Take some time, take some effort. Okay? But notice productivity doesn't double even though he's got twice as many ovens. Okay? So we'll get that. Let's graph this. Okay, output. Okay, we got capital and we have output. So like in any chart, left to right means more capital, right? Bottom, low to high means more output. Okay, so we're going to graph this. And it's similar to potential GDP, which you might have heard me talk about in the past. Think of this, like if you thought your output, like GDP, in the United States, like we saw earlier in this presentation, the United States tends to grow at roughly 2% a year. So every year, 2% growth, 2% growth. 2%
Cool, right?
More and more tools, more and more computers. They're all good.
Ahead.
You have to spend some time like cooking it. Amazing. Okay, square root of capital.
Anyways, anywho, so I hope that answers your question. All right. There you go. Oh, by the way, it's $88 a year for everything. Yeah, you're welcome. All right, so going back to this. You develop a strategy. You decide if you're a bull or a bear. Okay? And you look at this chart and you say, well, just technically speaking, this seems to be a downtrend. Now, you might be wrong. Over time, you'll know. But right now, you don't know. And you're like, well, it's more bearish than bullish. Good. So when you drop into a smaller time frame, you're only looking for opportunities to sell. Does this look like a good opportunity to sell? It's the same currency pair. The only thing is we're looking at it from a different point of view. As Einstein said, it's relative. The theory of relativity has to do with where you are in space-time. Well, whether you're bull or bear is relative to where you are in the price-time continuum. Now, on the daily chart, you said you were a bear. So you might look at this chart and say you're a bull. So what do you think is best? You can't see. Hang on. I can't see what you can see. I can't see. Hang on. Let me know if that's a little better. I'm not. Am I watching? Oh, I am watching. Yeah. Okay. I can see over there. Hang on. I have to move a bunch of things around. Oh, and I see what's going on. Oh, I know how you usually do these webinars. Hang on. I see what you're doing. All right, hang on. Let me get this together. Okay, let's see. I got the stock market here. Let me move that around. And then usually I put this under the, yeah, okay, there we go. That's better, huh? What do you think? Smell better? There we go. That works. Hua. All right. There we go. Thank you, Jimmy. All right. So what do you think you should be planning here if you are a bull on the daily chart? What do you think we should do? Talk to me, Goose. Okay. While I wait for that, today I'm going to use Trader's Way. Okay. For watching the stock market. I'm also using their live account here. If you need a foreign exchange broker and you want an ECN, I recommend tradersway.com. You're like, Wayne, what's an ECN? They use straight-through processing to enter your trades into the interbanking system through their liquidity partners, which means you click a button and the trade goes through, many, many, many other brokers use a completely different model. And you click a button and they manage the trade. They may not actually enter the trade in the interbanking system. In particular, if they have a model based on you failing, think about how many brokers work. Not all of them, of course, but many. You put, what, $1,000 into a trading account? And if you're an amateur, what's the likelihood that you're going to lose the whole $1,000? Pretty high. So, you would have to think of what could the broker's business model be? Well, they can make, every time you put in a mini lot, they can make their $2. Or they can just say, you know what, this dum-dum, he's going to blow up his trading account. We're not even going to enter the trades because if he loses all his money, we get to keep the whole $1,000. We don't make $2 on 100 trades and then he blows his trading account up. So many, many, many brokers, they have a model of B-booking you is what it's called. So they put all the losers into a bucket and they hope you lose your money because then they get to keep the whole thing because you've blown it up, but your trades were never actually in the market, right? So whatever. Not all brokers are like that, but many are. Many are. With an ECN like Trader's Way, you click a button, it just goes straight into the interbanking system. There's no B-booking. There's no nothing. That's it. It's gone. They don't manage your trade. There's no dealing desk. It's just boom, it's gone. So if you like that, hey, tradersway.com. Okay, Brian says, buy the dip. Wrong. Okay, wrong. You don't buy the dip here. Does anyone want to guess why? Why would I say buy the dip is wrong in this situation? Because the long-term trend on the daily chart is bearish, so you're going to be more productive by trading in that longer-term trend. So you would, in this situation, be better off, most likely, waiting for price to drop below the ribbon of moving averages, come back, retest the moving averages, and then drop it like it's hot. And the moving averages would look like this. Okay, and then these moving averages would look like, oops. Okay, let me put another one in there. Okay. Okay, so you'll see price drop below the ribbons and then also then use the ribbons as resistance instead of support. And you'll also notice a rollover, okay? That rollover would occur over here like it did here, okay? And you would sit and wait. And what if that doesn't occur today? Then you don't trade today and you don't lose money. Okay, but Terry gets it. All of a sudden, Terry's like, oh, because buying the dip would be a bull move. Correct. So that's what my book was about. Strategy first that sets your bias. Then tactical entries and exit based on technical analysis. Just short time frame, day trading, swing trading, that kind of stuff. Okay. How lovely. How lovely. Hey, did you click the thumbs up button? Out of respect for FX Street for being our host today. Help promote their YouTube channel, huh? Help them hit the algos. Just out of respect for our wonderful host, please click the thumbs up button. Okay, what about fundamentals? See, we're talking about fractal geometry here, where the daily says down, okay, the 15 minutes says up. What do? You wait until you have congruency. What about fundamentals? Okay. Well, there's a lot of things that we can look at. Obviously, we want to know fundamental trends and we want to know technical trends. And we want to know like what's moving now. So if we're just going to look at majors here, okay, I'm looking at the scatter plot. Okay. And you know what this shows me instantly? The markets are out of alignment. Everything that should be weak is strong. Everything that should be strong is weak. And it's probably due to non-farm payrolls coming up in the not too distant future. But it might also be related to the election on Tuesday night. Okay. By the way, if you want to, if you want to attend Tuesday night's election, I'm doing that at FX Bootcamp, but you'd have to be a paid member. I was just going to say, oh, you should, come to my YouTube channel, but I'm not doing it at a YouTube channel. I'm doing it inside FX Bootcamp, but I'll do it for all members. So you can join for $88 a year, and I'll still give you access to the live event. And we're just getting pizza and beer and watching the talking heads on TV. We're also preparing for some scalps and some counter trends and then setting up the bigger trade the next day. So if you're interested, you would still have to join FX Bootcamp. Again, it sounds like a sales pitch, but look, dude, it's only $88 a year. So I don't know, join. So, but anyways, going back to the scatter plot, I see a big warning sign about market conditions. So I immediately go neutral. Oh my God, I don't want to trade that garbage. So it's kind of like that Aussie dollar trade we're looking at. I want to get short, but it's rising. So what do? Nothing. And it takes discipline to do nothing, but a fool and his money are easily departed. Okay. Now we can change this and maybe just look at minor pairs only, right? Crosses. And some things are doing as expected. Okay. Like everything, the way that you read a scatter plot, by the way. Do you remember your 7th grade math class? Do you remember when they were teaching you the concept where they said a negative plus a negative is a positive. A positive plus a positive is positive. But a positive plus a negative is negative. And a negative plus a positive is negative. Do you guys remember that? They're setting you up for calculus because you have to break this down into more digestible pieces, but they didn't really explain it to you, huh? So you take the zero bound and the zero bound and you create a quadrant, okay? So calculus. And what they're trying to say is, in this case, we're studying a data set of current prices relative to their fundamental scoring. So price versus bias, let's say. Is the price doing what the bias expects? Okay, that's the question. So using a scatter plot, you see some things you figure we're going to be bullish but are currently bearish. So that's a negative. And then you see some things that are making money right now that shouldn't be making money. They should be losing money. So that's a negative. So a positive plus a negative is a negative because you'd be losing money because it's doing the opposite of what you would think. And something that is making money but should be losing money, in that scenario, you'd be losing money because it's not doing what you would expect it to do in these market conditions. But everything up here, if you look at everything at the top right quadrant, the scatter plot is showing you that if you look at everything fundamentally, things like employment and GDP and inflation and interest rates, okay, institutional positioning, retail positioning, you would look at all that data and say, oh yeah, all these assets, right? All these currency pairs are likely to go up. And they did go up. So a positive plus a positive is a positive. But everything here, Euro CAD, Euro Kiwi, Pound Kiwi, Euro Aussie, okay, Pound CAD, in the bottom left-hand corner, if you added up all these things fundamentally, again, employment, inflation, interest rates, okay, institutional positioning of these trades, seasonality, you would look at all these pairs and say, oh, they're going to fall. And they are falling. So a negative plus a negative is a positive. This is a big positive because that's what you would expect. So you'd be selling these, and if you were selling them, you'd be making money, and that makes you happy because it's positive. You see? So this is a giant positive, okay? And this is a giant positive. This is a giant negative, and this is a giant negative. So this is what's feeding your family today. This is the bad stuff. But you know what? Another way of looking at this is all these pairs are out of alignment, and all these pairs are out of alignment, and that price action might not last, where these are probably in the near future going to get negative. And these in the near future are probably going to get positive. So you might be looking at those for next week's trades. Oh my God. And I got that in like 1 second. Okay. What if you're throwing in commodities or stock indices? Okay. We can just look at stock indices here. Okay. And it's an up day and a down world. Except for these ones. Okay. You see, look at. Okay. Germany and the UK are rallying as expected. And these ones are rallying, but shouldn't be. So it might change. Or it's in the process of changing now, and therefore, well, you want to ignore them because you're out of alignment. Isn't that neat? So today we're going to do gold, oil, and Bitcoin on commodities. Can you please tell me on the Dixie, buy or sell on the yen? Well, technically or fundamentally? Well, if you're bullish on the dollar, then you're telling me the S&P 500 is going to fall. Take a quick look here. Retail sentiment, otherwise known as dumb money, institutional sentiment, otherwise known as smart money. Now, I disagree with those terms, but those are common terms. Dumb money is buying pound CAD like crazy. So we should look to sell. How does that make you feel? Aussie Kiwi, 87% of retail's long. Aussie Swissy, 87% of retail's long. Isn't that interesting? Now, smart money we can break down into bigger detail, and we can actually see the positions. Long oil, long dollar. Okay. Short Japanese yen, short Swiss franc, short Aussie, short pound. So whoever said, hey, they want to know, should they buy or sell Japanese yen? Well, that's between you, God, your accountant, and your bartender. I don't know what the hell you should do. What should you do? I'm not your mommy. Okay. But I can answer the question differently. It seems to me that the vast majority of institutional investors are short the Japanese yen. Okay. Oh, so you do you. Okay, they're long the US dollar and they're short the Japanese yen. So what should you do? I don't know what you should do. Cool. Okay, cool. So anyways, I'll give you a sample of the full report going over all the different currency pairs and stuff. Let me give you a link. You can go through everything. S&P 500, like the stock indices, commodity pair, commodities like gold, oil, 10-year T-note, it's in there. Dollar pairs, yen pairs, it's all in there. Retail positioning, institutional positioning, it's all there. If you want to try it out, check it out. For free. Hey, Lucas. Guten Morgen. Yeah. All right, so that's that. So we're trying to line up long-term fundamentals with short-term technicals. So that's how I would handle the scenario with Aussie dollar versus US dollar. Okay. So let's take let's move a bit. Let's move. I got to move. Get me the juice. Taking a look at my WTI. We got some 4-hour price action going. I'm a bull on US dollar. Or sorry, I'm a bull on US oil. Okay. That's a standard setup. The way that it looks, right? Let me draw this down. The way that this works, this is a higher low, trust me. Then it makes a higher high. So now I'm going to look for a higher low. I don't know where the low is going to be, so I look. So remember, I'm up here at this moment. I look backwards and look for the old resistance. Resistance, resistance, resistance. There's a lot of resistance in here. So I'd assume, again, when we're way at the top, when we're still at the top on the higher high, I'm already thinking about I want to buy the higher low. Probably around there, higher low. Okay? And we rinse and repeat this. Now, there's two ways to handle this one. You might call this a higher high, but you might not. You might not. It's not much of a higher high. Okay, so there's a couple of ways of trading this. Okay, and again, you can learn this all in the training courses at FX Bootcamp. Again, if you don't have 88 bucks, I can't help you, but the help is there. If you need help, the help exists. Okay? Anyways, there's two ways of trading this based on your bias. Okay? Buy off the old pullback. Again, that's still a higher low. Off of, okay? The next one, so we call this a trap and break, by the way. Yeah, sure, I'll do Bitcoin. Not a problem. So this is called a trap and break, where if you're a bull, you buy at the bottom of the range. Or you buy on this break. You see it? You had like an hour or more to set that up. So we're talking about, let me mark this and then drop into a smaller time frame. Let's mark this and then drop into like, what, a 5-minute chart? Okay. And you can see how long we farted around there. Look at this. Up, 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 down, down, up, 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 up. Okay. Now, the other type of trap and break that I teach revolves around markets, market opens and stuff like that. So there's the other way. It's the same idea, but it's you trade after the breakout, you catch the pullback, and then you're gone. There's with WTI on an intraday basis, there's a time for counter trend trading, and I don't need to get into that, but it's based on profit taking. Okay. I was asked to do Bitcoin. Bitcoin tells me absolutely nothing except don't trade anything. So like with the pound, with the Aussie dollar pointing down on the daily, but the Aussie dollar is pointing up on a 15-minute chart, that tells me don't trade. When I open up QuantBox and I look at the scatter plot, the first thing I see is don't trade. I look at Bitcoin and I use it as a gauge of risk on or risk off sentiment. And in 1 second, I look at it and go, don't trade. You see? Don't trade. Don't trade. That's what it tells me. Protect your capital. Don't deploy your capital. Protect it. Cool. All right. Why? Because it's not moving. That's it. It's done. It's dead. Why don't you like beat a dead horse? Okay. Yeah. All right. So look, we don't have much time, but I do want to talk about Jay Powell, the FOMC, the interest rate decision, and how that impacts today's news. Okay. All right. Jay Powell said they're going to wait for the cumulative effects of past interest rate hikes, that the pace can slow. But he also said that the terminal rate is likely to be higher than what they originally had anticipated. So, a slowdown in interest rate hikes to allow what they've done in the past to work in the future, but they don't see an end yet. They're not even close to that. Probable dollar strength is my call. But here's the thing, and you're ready for this? And it's going to impact us today in just a few minutes. They've already made a decision. Is it really going to be important for non-farm payrolls if they've already decided that they are almost certainly only going to raise interest rates by 50 basis points in December? If they've already hinted toward that decision, they basically leaked it. So like, what could NFP possibly mean if they've already made the decision? Do you understand that NFP today has to be so radically out of expectations? It's like plus 50,000 or it's plus 450,000. Like in that case, that's almost, it's incredibly unlikely. Is it possible? Oh, for sure. But I would look for revisions before I swallow that hook. But now if you are worried or you think there's going to be a giant number or a tiny number relative to expectations, well, you're shooting for like the 2% likelihood stuff. Like you're 98% probably wrong, but it might happen. Now, if it actually happens, maybe it does have an impact, and I'll deal with that. I'll deal with that after the fact. But there's, if you use 2 standard deviations as a method, that's 95%. So within 95% certainty, right, we're going to be, not incredibly low or not incredibly high. It'll be like about kind of roughly as expected and therefore irrelevant. The reason I bring this up is that's how the market is trading right now. And I don't want you to really overtrade. Because I look at all these charts that I just showed you, whether it was fundamental stuff, the scatter plot, Bitcoin, gold and oil, and Aussie dollar being misaligned long-term versus short-term, everything screams, hold your horses, Bubba. I would not recommend aggressive trading today, over trading, go, 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 rah, rah, rah. It's okay. I think you're going to get better, bigger trends, smoother trends next week. And today, if anything, if it moves, you're probably going to get a pop and stop. So let's say it jumps 75 pips and stops, or drops 75 pips and stops. Or it jumps 75 pips and then drops 75 pips. Or it drops 75 pips and then it jumps 75 pips. And by jump, I mean over the course of, let's say, an hour or two. Okay? So please, don't overdo it today. It's your opportunity to be patient, to be disciplined. Okay? So while we get ready for the number coming out in a few seconds, let me remind you, if you want that try out the fundamental service, try that. If you want to try Trader's Way, open up a demo there, try an ECN. You might find it faster and pays a higher yield than your current broker. If you want to watch 65 hours of training videos that I do, that's at FXBootcamp.com. Okay, that's only $88 a year, and I've been corrected. People have told me it's much more than 65 hours of training for $88, much more. So $1 an hour seems pretty fair. So all those resources are made available to you. If you want to try, add some fundamentals, add some technicals, improve your trading strategies. Okay. 261, thank you. That's about right. It's a little on the hot side, but it's not radical. Okay. Not a big deal. Let's take a look at the indices. And thank you, moderator. Thank you, FX Street. We have the world's greatest moderator, I'm telling you. Okay. So here we are. We're looking at short-term indices. Aussie is relatively strong currently. That's why we're not selling it. Pound is quite weak. Dollar looks like it's trying to gain some strength off the news. Let's try it on a 5-minute chart. Yep, dollar's gaining. That's great. Okay, pound dollar should be falling. Okay, yen is strong in the moment. CAD is strong in the moment. So euro dollar and pound dollar seem to be the best opportunities. Let's take a look. We'll keep Aussie aside. We'll keep USD Kitty Cat aside. We'll do this one. Okay. This is falling. Okay. We just dropped off of a yearly pivot point, and now we're back to the lower yearly pivot point. Back below parity, obviously. And the next real interesting move would be dropping this down to 90. There's what, almost 800 pips below us. Okay. One of the things we're doing right now, let me clear this. One of the things we're doing right now, this is a daily chart, and we just sold off the daily 5 EMA. Amazing, huh? Lovely. Okay, lovely. This is the last chance for bulls because they're going to look at it like this, aren't they? Wouldn't you? Like, even if, and by the way, let me ask you, does anybody know if I'm a bull on this pair or a bear on this pair? Let's see if people actually know. Yeah, thank you. This is good because it keeps me from like talking from both sides of my mouth, so to speak, right? Of course I'm a bear. Good. So one of the things I'm trying to show is let's measure the data set. Oops, wrong one. Delete. Close. Come on now, close. There we go. Okay, let's do this. We're going to measure using this study. And then we're going to measure using this study. And all we're doing now is analyzing the data set. And I guess I'm not analyzing the same data set. Why is it so far off? Interesting. Why is it not working? Hang on. What am I guess that's closer to what it should look like. Interesting. Something's not quite right, but what's going on? They should be at the same slope. So I'm just slightly off somewhere. There might be a slight... That's even off. That's interesting. I don't think I've ever had that. The math is not lining up. Huh. Well, that's close, but it's not precise. One of these studies is not... I guess they're just slightly off when it comes to the daily candles. Huh. Interesting. Anyways, they're supposed to be about the same. Yeah, well, I've been going back, right? I've been going back and forth, Lucas, on when I started the study, and they still don't line up. I can't get it quite right. Oh, is it this one for some reason is not doing the end? Okay. Okay. All right. All right. Thank you. All right. So what this is telling us is if you're a bull, that's your last chance, your lowest chance to be a bull. And anything below that is unbullable. Oh, no, Jim. You're hanging on to something I said last year, but the central bank policy has changed. The situation has changed, but yeah, no. I didn't change my tune. The central bank changed its policy. But yes, I did say that a year or more ago. But I'm a dollar bull. And it's just the central banking policy. But I'm not a bear. No. I do what the Fed does. Okay. Now, if the Fed was raising interest rates because of the economy expanding, which is normal, okay, I should make that point, right, Jim? If the central bank was raising interest rates because the economy was expanding, and we were in a growth scenario, which is normal. Usually when the economy is growing too fast, the central bank raises interest rates. And in that scenario, I would be a dollar bear for sure, without a doubt, 100 times over. Okay? But right now, the central bank is raising interest rates, but not in a scenario where the economy is expanding. The economy is contracting. It's the contraction, the global contraction, that brings dollar strength. It's not really the interest rate hikes. The interest rate hikes describe a scenario in which we are in, but the outcome of it is what we're trading. And the outcome is we have slower growth. Yes, we have high inflation, but the global economy is going into recession, and the flow of capital is to the reserve currency. And I'd actually take that further. I don't think the flow of capital is to the reserve currency. Okay? What I think is going on is that central banks around the world are starting to hoard dollars, with the exception of the People's Bank of China, the Bank of Japan, and to some extent the Bank of England. Now, the Bank of England doesn't really want to dump dollars, but they need to buy the pound. So they did that for a little bit. The Bank of Japan is in serious trouble. And they've been selling their yen to buy energy. Okay, Japan spends 100% of their GDP on energy. And every time they buy a barrel of oil, they need to sell their yen, buy the US dollar, and then buy a barrel of oil. So what does that look like on the long run? So let's go there for a second. Are we on dollars? Yeah, we are on dollars. Let's go there for a second, if you don't mind. I don't have a yen here. All right, well, let's go into a yen proper. Okay, we'll look at it here. Okay, what does it look like when a country is desperately short of energy and needs to buy energy at any price? Actually, I need to go farther back. That's only a 4-hour chart. A country has zero energy and they need to buy it at any price, regardless of price being up because of a shortage due to supply chain issues that we had earlier, or a shortage because of war. But price has been going up for oil. It went all the way to 120. And Japan doesn't have a choice. No matter what the price is, they're going to buy. They're a price taker. They're not a price maker. They're not a market maker. They take the price the market pays. It doesn't matter what the price is. But the higher the price of oil, the more that yen has to be sold to purchase dollar to purchase oil. So the flow looks like this. Oil, dollar, yen. So yen is converted to dollars, dollars converted to oil, oil is brought to Japan. And what does it look like with that when the flow of capital is like that? Pretty amazing, huh? And can you see why 83 or 84% of institutional investors are long this pair right now? Is that good information to know? Okay, this is based on government data, not opinion. Let me show you. Let me construct this. Institutional traders are, what, 78%? I can't see the exact number. I have it down here somewhere. But the vast majority is long dollar and the vast majority of short Japanese yen, which does what to the pair? Long dollar, short yen. And why is that going on? Because look at the demand for oil. Again, 80% are long oil. Holy smokes, huh? Okay. Yet retail traders are uncertain about the US dollar. Where's that oil? No, retail traders are uncertain about oil. Retail traders are actually slightly short USDN. And they're not sure about oil. And institutional traders are very certain about dollar, very certain about oil, and very, very, very certain about yen. Retail, not so certain. They don't know. They don't get it. Isn't that amazing? Cool. You guys want to do gold? Gabriel, I mentioned earlier that I'm not happy with any of the market conditions right now, and I'm waiting basically till Wednesday to get back into trades. Oh, got an error. Interesting. It's not pulling in from one of the data suppliers. Wonder what's going on here. I'll have to send maybe a message to the team. Oh, what is this? Okay. Yeah, all right, so not pulling in properly. I'll have to yell at the developers. We'll see what's going on. All right, we'll come back to that as it tries to pull in the data. Remember, it's live, right? It's live. It's gathering the data in real time and crunching it. All right. Anyway, so it just shows you what's going on. Another way to express my feeling when somebody's there, like says, so what am I trading today? Well, I'm not that interested in trading today, but I already explained why. But I can tell you that bulls live at this price, bears live at that price, and we're in the middle. So it's really not that great one way or the other. Or refresh a page. No, it's not that the page needs to be refreshed. What I was trying to say is this is not a static page that you just pull up an image. No, I'm logged directly into the Google Cloud, and it's actually crunching the data, but for some reason it's having trouble pulling from one of the data suppliers to do the calculations. So like it knows the seasonality of oil. It sees the price. It's calculating price projection. We have the calendar for oil, but somewhere it's having problems pulling in the fundamental data. And so now it's lagging. But I can try it. I'll refresh it. But again, it's not trying to just show you an image. It's the live data. Okay, so anywho's. It can happen. There's a lot of complexity going into those calculations. All right, so anywho, let's take a look around the world. Let's take a look at that. So that's the explanation of the relationship between oil and yen and all that kind of stuff. Okay. Going back to this, we can see a recovery. Let's look at it from a smaller time frame. Okay. Do you remember I said what I expect today? It's one of those days where it drops 75 pips and then rallies 75 pips. That's kind of what I'm expecting. So I don't really care. You can have this. It's yours, man. You want to trade today? You think that's the market setup you're looking for? Then go ahead. Do you. You do you. I'll catch it later. Mm-hmm. Hang on. I'm going to let the team know that we're not getting stuff. Hang on. Copy. Hang on. I need to send an email to the team. Hang on. All right. We got that taken care of. Cool. Let's take a look. Let's go back to commodities. Let's go back to, or do you want to do exotics? Let's do exotics. See how this is impacting people today. Let me reset my windows here, tile vertically. Okay. And this is what I'm doing here. So on this trade, I'm currently up just over 200 pips. Okay. So I have an internal rate of return of over 200%, which is not bad for the girls I go with. We can break this down, and the logical entry on this trade, oops, delete. Okay, the logical entry on this trade, okay, was this was the trade plan. Okay, so I got in around, well, I got in here because what actually happened, okay, that was the plan. What actually happened was pop. So put me in, took me down. So what does it mean, Basil? Talk to me, Goose. Well, that's a kickoff, what we call the central pivot point for the month of November. So I'm short there. And that target predicts this exit. That's the projected low for the month of November. Now you're like, well, Wayne, why didn't you take profit? Well, first of all, this is my coaching account. Okay. The second thing is I'm also trying to teach carry trading. It's a big part of being a Forex trader. The only thing is we've had low interest rates for so long that the vast majority of retail currency traders today have never experienced collecting a yield. They don't know anything about it. And yet it used to be the most important thing about being a trader, a currency trader. Okay? It was the most important thing. It was the reason you traded currencies. But if you only have 10 years of experience of trading Forex, then you don't know anything about what used to move the entire market. Cool. So the world is going to change, and much of what you learned over the last 10 years may be slightly irrelevant. Things may change back to the way they used to be, and all of a sudden you don't know. Yo. Huh? Your arms and knees are weak. Mom's spaghetti. Blah. Yeah, important stuff. So anyway, I'm trying to teach FX Bootcampers, and I'll teach you, the importance of carry. I'm also trying to teach patience and discipline. I'm also trying to teach how to stay in trades a little bit longer, but also the risks associated with those decisions. Because I'm trying to have you, well, be a little bit bigger. Not in lot size, but in your conviction for your trading. And you might say, whoa, what? What do you mean conviction? Yeah, that you stand for something. No, Master Trader, I said it could, that it has been, that it usually is, that it is seasonal, that it wouldn't shock me if it stayed weak, but it's not my bias. My bias is the global economy is crashing. It's crashing now, but if the dollar rallies to December, the global economy is still crashing. It doesn't change a damn thing, Master Trader. So if it stays long for 5 or 6 weeks, I keep converting. Sometimes I'm thinking euro dollar, and then the next thing I'm talking about US dollar. So let's say, Master Trader, if the US dollar became weak all the way to the end of the year, that doesn't change my bias. And what I teach is that I could recognize it. I could recognize that. And I could trade it. I could be short-term, short the US dollar, which is fine. And then yesterday in the swing trading group, we talked about it, and I said, I might do it. I probably would do it, but I wouldn't like it. And then I made jokes, right? I'd feel dirty about it. I'd feel dirty. I'd buy the euro dollar, make money, and then cry in the shower so nobody could see. I just can't get it off. I can't get the euro dollar off me. It's so, right? I would only do it for income, but not for asset appreciation. Do you understand? So I would do it to pick up pennies and quarters while I wait for my trade to set up. And my trade would be sell it hard the first week of January. For example. Well, Wayne, what if it's up for 5 weeks? Well, what if it's down for 30 weeks? Then you do you, and I do me. But the thing is, you have to know the difference. And most retail traders, they don't know the difference. They're not long-term long, short-term short. They're not like fundamentally bearish, but currently buying dips on a short time frame while you wait to head up to a higher, no. They're just reacting. Okay? You know what I'm talking about? So hopefully that clears it, Master Trader. I could be long a pair for 5 weeks, but it doesn't necessarily mean that's my bias. My bias is much longer than that. So when a central bank changes its policy, that policy change usually lasts years. So I'll give you an example. Around 2009, I think it was, the Fed started a process called quantitative easing. Okay? When they did it, and let me change this template here. When they announced quantitative easing, the US dollar was the strongest currency on the planet. Very similar to today. For opposite reasons, but similar. Okay? So they invented a thing called quantitative easing. Okay? This is the quantity of money. Okay? And this is the value of money. Up means more, stronger value. From left to right means more money. Here's 0. We can call this 1, 2, 3, 4, 5, so on. Okay? Trillion, quadrillion, whatever. They're just units. More value, 1 value, 2 value, 3 value, 4 value, 5 value. All right. Now, one of the things you need to track is the demand. Oops, I wanted that to be blue. Come on now. There we go. One of the things we track is the demand for money. In a growing economy, a lot of money is needed. You get paid a lot of money at your job. Your company is very profitable. It's very generous. It has a lot of customers spending lots of money on the products and services, so there's lots of demand for that. And now you have lots of money, so now you go to Home Depot and fix up your house and hire gardeners, and there's lots of demand. Everybody needs money because remember when I said savings is equal to investment? Your spending is equal to income. Your spending is somebody else's income. And what do they do with their income? they spend it. And that spending becomes somebody else's income. So you have a job, you get your haircut at Applebee's, then the woman at your haircut at Applebee's, it's funny. You have a job, you get paid, you want a haircut, so you go to Supercuts. And you pay them money, they cut your hair. Now the woman at Supercuts is hungry, so she goes to Applebee's and spends her money, which she got from you, which you got from your job at Applebee's. And now the waitress at Applebee's, right, goes to Supercuts to get her haircut. And she spends the money you got from your job that you spent there, they're spent there. So your spending is somebody else's income, like your savings is somebody else's investment. And so a growing economy tends to demand more. A shrinking economy tends to demand less. Okay. What about the supply of money? Is it a downward sloping curve or an upward sloping curve? See, you guys took for everyone that took the training course, you already know. See, smarty pantses already know. Right? So if you didn't know, you need to join FX Bootcamp. Other people know this. When we're talking about the supply of money, it's not determined by demand. There's just a supply. Whatever the government has put into the market, that's the number. That's the amount, 3. There's 3 number of dollars, 3 units of dollars in the economy. No more, no less. That is the supply. So it's not like a typical supply and demand curve where, if demand is high, then it incentivizes suppliers to supply more and because there's a shortage and the shortage pushes prices up, therefore suppliers supply more. And then there's a surplus and the surplus pushes us back to equilibrium. No. The Treasury printed 3 units, whatever it is, $3 trillion. That's how much there is, no matter what the demand. So, going back to QE, what happened was the Fed in 2009 entered the market and purchased, let's say, 1 trillion units of bonds. And they just created the money on a computer. Okay? They didn't print the money because the Fed doesn't have the printing presses. The Treasury has the printing presses. So when you read things like the Fed printed $5 trillion, no, they didn't. They create credit, but they don't print money. So when you read that, the person writing it is wrong. But anyways, so this amount of money is created, okay? The supply goes from 3 to 4, so the supply increased, okay? This is important because I'm telling you, when the policy changes at the Fed, my bias could last years. A few weeks up or down is irrelevant. Okay? So we were at this value when we were at the original equilibrium. And now we're at this value on the new equilibrium with the newer supply. and the value of money fell. So we went, starting in 2008 or 9, QE1, QE2, Operation Twist, QE3, even a QE4, really. It lasted years and years and years and years and years. And what does that do? Lowers the value of the dollar. And that could last a very long time. Yeah, my internet's slow. I'm only getting 270, 280 right now. And that's very, very, very slow. So I don't know what's going on. But it still should be more than enough. Hey, did you click the thumbs up button? Did you tell YouTube that FX Street has quality content? Would you do that, please, just out of courtesy for our host? Oh, look at that. It's cool. It was showing me a thumbnail of the drawings that I just did. All right, cool. It was showing me a thumbnail of the drawings that I just did. All right, cool. All right, so I just wanted to see if you're clicking the thumbs up button. Huh? Are you clicking the thumbs up button? Just checking in on you. Well, the exiles, I'm a stickler for language because it's our form of communication. So if you use the wrong words to describe a concept, you could be misunderstood. So I'm a stickler when people say the Fed prints money, but the Fed doesn't print money. That's the thing. You can't say the Fed prints money. The Fed doesn't print money. It's just factual. So when you're like, oh, this is the Fed's fault because they printed 5 trillion US dollars. No, they didn't. Okay? In fact, I'm not sure if the US government printed any money. The Fed would have created credit for the banking system to deploy as investment. And the US government, more likely, instead of printing, they probably just borrowed money. I don't know. I'd have to look it up. Did the Treasury print any money at all? I don't know. But the White House could have said, hey, borrow money and give it away for free. That is one thing. They could borrow the money from foreigners and then give the money away for free. Hey, they borrowed it, whatever. The second thing they can do is actually go to the Treasury and print the money. Just literally print it. And now give that away for free. Okay, and the third thing, which is quite different from the other two, the Fed could generate credit, and they give credit to a bank, or let's say credit to a bond dealer. The bond dealer is part of a bank who now has that credit on their balance sheet. Then the bank with the credit gives somebody else credit in their account for a mortgage, and that credit gets transferred to a mortgage holder who just sold a house, and there's a transfer of the ownership of the house. and then somebody moves into a house. And then because they're a homeowner, their credit score goes up. You see, but the Fed doesn't give someone that can't pay their mortgage money. That's different. The U.S. government gave people money for free. The Fed issued credit to financial institutions who can go out and deploy the credit to credit-worthy projects. Companies that want to expand their business or borrow short-term to cover cash flow, or to consumers that want to buy a house. But they don't get like a free mortgage because the government wanted to save the economy. The Fed wanted to save the economy. No, it doesn't work that way. So I just want to the language is important because they are very different concepts. And I hear stuff in the media that makes me cringe a lot of times because people might believe them, but they're wrong. You understand? They have a very elementary concept of what's actually happening. It's like a 5-year-old explaining the economics to a 3-year-old. Well, the 5-year-old sounds really smart, almost twice as smart, but it doesn't make it right. So a great example of that would be going back to gold. Where's gold? Where's my gold? And I killed this. This used to be gold. All right, so let's put this back to gold. XAU. I'll get rid of that indicator. All right. Let's look at this. Most people here know for a fact, meaning it's common knowledge. I know that you know that I know that you know. That's what common logic is, common knowledge. Everybody knows you buy gold during times of inflation. Would you agree with me that that's common knowledge? Do you think that's common knowledge? Buy low, sell high. Let your winners run. Cut your losers short. And buy gold to hedge inflation. Is that a reasonable universal truth? I think that's what you think. That's what the textbook says. Anybody else? Is that what your grandpa told you? My mama told me when I was young, sit beside me, my only son. Buy some gold when inflation's fast. Listen to this, boy, so you will last. Huh? That's it? What? Only 2 people answered? Really? All right. Anyways, I think the answer is yes. Really? You won't answer yes? What are you guys, shy? The XO says, yes, I don't agree with it, but many believe it. Yeah. All right. Buy gold. Okay. No, I wouldn't say that either, JJ. That would be wrong. Buy gold when there's not inflation. No. That's also wrong. All right. We have extraordinary amounts of inflation globally. This is not just a US dollar issue. We have rampant inflation. The highest inflation in the UK, the highest inflation in Europe in generations, the highest inflation in the United States. And all around the world, and by the way, I think it's going to get way worse, not better. So there will be a time when when I want to corner the market on gold. It's just not right now. So I would say your grandpa was right. You do buy gold in times of inflation. However, every central bank in the world is enacting policy of deflation. It's the policy that matters. Yes, we have inflation. The central banks are trying to kill it. That's deflationary. And you can see this by the value of gold falling. And again, this is my super simple template to give you a very basic idea. It doesn't need to be more complicated than this. And you look at this and gold is not bullish. It's just not. Not on a daily chart. And if you go out onto a weekly chart, definitely not. Okay. It's bearish now. It was neutral for a long time, but it used to be very, very, very bullish. In particular, we can focus here on the left. What occurred? Okay. What occurred in early 2020? What's up, Danny boy? Yeah, boy. COVID. What happened to the currency market during COVID? Yeah, exogenous shock. Matrix, you have to do a shot of tequila. Every time exogenous shock is used, you have to do a shot of tequila. Okay, let's talk about this. In places like India, the entire country of India was locked down. The streets of Mumbai were a ghost town. Unbelievable. Aaron says US dollar spiked. Well, every currency spiked. But we'll pick on India because it's a great example. And I talked about it while it was happening, by the way, guys. Back in that moment, I was describing it to everybody. So this isn't sort of after the fact preaching. Let me tell you how smart I am. You should have bought gold. I was talking about it as it was happening. And not talking about it, explaining it. So India locked down their entire community, their entire country, their entire economy. And there was shortage of money, literally a shortage of money. You needed money now because you were locked in your apartment. And the flow of money was diminished. Many, many Indians have money deployed outside of India. They've invested into the US stock market, for example. So they say, oh my God, I'm short on cash. By the way, this happens after a natural disaster. Like in Japan, if there's a massive earthquake and tsunami and an entire city is destroyed, guess what? All those citizens need money to clean up and repair their properties. So the demand for money goes up. Therefore, right? Remember the demand curve? The demand of money goes up. So let's just do it really quickly here. Okay, remember quantity, value, the amount of money available, in this case, we're talking about the interbanking system. So we'll say that's the quantity of money. So that doesn't change. Okay. Okay, that's supply of money. And let's say the original demand is here, but demand increased from D1 to D2. So I have to label all these. D1 to D2. Okay, so demand shifted to the right and increased. Quantity is this way. But there's only a certain amount of money, but everybody needs some of that money. But there's lots of competition to get the money. So you go from value 1 to the value of value 2. Am I making sense? Okay. So the increase of demand for money pushed up the value of the money. So in this case, in India, citizens of India were locked in their apartments, and this increased the demand for money. So the value of the rupee went up. And this is bad for an exporting country like India. So the central bank said, what do we do? The Reserve Bank of India, what do we do about this problem? The value of the rupee is too high, and it's going to make things worse in India, not better. How do we weaken the value of the rupee without destroying the economy? So you have a balance sheet, assets and liabilities. This is at the central bank. Okay, let's say they have $1 billion in cash. Okay, and they decide to take some of that away. So now they only have 500 M in cash. And now they have 500 million in gold because they bought gold. So this is cash. This is gold, XAU. So what has changed on the liability side of the Reserve Bank of India's balance sheet? Has the balance sheet changed? Nothing's changed. What happened to the value of the currency? The balance sheet is the same. What's changed to the value of the rupee? Type in a question mark if you're following along but you don't know the answer. Thank you, Kareem. Thank you, Danny Boy. All right, so let's plot this out then. Let's talk about it logically. So what we're seeing is that the central bank took 500 million units of their cash. I'm not saying it was 500 million rupee, but let's say they took cash. They sold their cash to buy gold. So in the interbanking system, okay, the quantity of money available globally in the interbanking system increased, lowering the value of the currency to value 3. Because what? Money going back from all over the world, but let's just say money being pulled out of the United States and pushed into India because of the lockdowns in India and the increase in demand in cash because of the lockdowns, pushes the value of the rupee up. The central bank says, ooh, that's not good. So what they're trying to do is either lower the value of the rupee or supply the high demand. There's a shortage of rupee. So the central bank says, well, we got a bunch of rupee in the central bank. So one way or the other, for whatever reason, I mean, I'm not sitting there talking to the central bank, but for whatever reason, either to lower the value or to supply the demand, the central bank puts cash into the interbanking system, bringing back the proper valuation with the increase of supply. But remember, they're buying gold to do it because they want to keep their balance sheet balanced. And this was occurring as inflation is skyrocketing because of a complete collapse of the global supply chain. And in fact, this whole process of devaluing the currency is, by definition, inflationary. It is inflation. That part of the inflation pushed gold up. It wasn't because of inflation. That's what inflation is. That's what it is. That's what your grandpa was talking about. But people are still talking about it now because they're like, dude, we have 9% inflation, yo, you should buy gold. Gold should be going up. No. When inflation goes from 2 to 3 to 5 to 7, okay, that's when you're buying gold because that's what the central banks are doing. And in of itself, it's like reflexive. It's that process that creates the inflation. You see? And so that policy has been over for a long time. And so those that are losing money, they don't understand. They think they understand. They think they know because it is common sense to buy gold to hedge inflation. But they don't understand the basic concept of you don't hedge inflation when it's at the top. You don't hedge inflation when it's not going to go higher. There's nothing to hedge. It's been hedged. In fact, it's expected to go lower from here. It's expected that we've hit peak inflation. Therefore, we are in a deflationary moment. Central banks are trying to reduce inflation. So what do? They buy their money. So you remember on the way up, they were selling their money to buy gold. But now they're buying their money. So let me ask you this for the $1 million question. If a central bank is buying money to push up the value of their money to crush inflation, what are they selling to buy their money? It's something on their balance sheet. What asset on their balance sheet are they selling to buy money to lower inflation? Why would you sell a bond that pays you income? Okay, now they might be selling bonds for different reasons. I'm not talking about quantitative tightening. I'm trying to see if you're following the concept of what I'm lecturing on. The central banks are fighting inflation by selling gold and buying their own currency. Now, some are actually selling dollars to buy their own currency, but that's for an entirely different but related reason. But I want you to get this concept. Well, JJ, you can't sell cash to buy cash. Okay? So they're selling gold, which is an asset, to buy money, which is an asset, so their balance sheet doesn't change, but the value of their currency goes up, and that pushes inflation down. And now you understand how to think like a central banker. Amazing, right? Look, are you going to join FX Bootcamp or what? If you don't know this stuff, I don't think you're going to survive 10 years of trading when you don't know what's going on. And it's amazing to me how many people, experts, don't know this stuff. But apparently you can trade for 3 years and start a YouTube channel and be an expert. I've been trading Forex for 5 years and I'm an expert. You hear that on YouTube and it's amazing. You're like, wow, you've been trading Forex for 5 years? I was at Harvard for 5 years studying macroeconomics and financial management. Like, that's it? You've only been doing it for 5 years and you think you're an expert on YouTube? You're like, you're a child. But anywho. Yeah, we just like gambling. Well said. So anyways, I hope you're having fun. I hope you're having fun. I hope everything's good. Somebody asked about a currency pair. Now, it's been a while. Which one was it? Oh, looks like the team got on it already. Cool. Now we're looking at oil. And let me break this quickly down for you. Okay. Compare, right? Check this out. GDP growth. Oh, let's do this in pink. It's just easier. GDP, unemployment, inflation, interest rates, 5-year and 20-year seasonal averages. Score it all up to get a bias. But the score includes technicals, not just fundamentals. Okay? Retail is 75% short. Institutional is 79.54 long. Retail's short oil, institutions long oil. I'm a bull on this. Okay? I'm a bull on this, but currently, quantitatively, you should be neutral. How nice is that? So I wonder if gold is updated. There we go. Gold. Gold. Same stuff. Look at all the fundamental data. 75% of U.S. traders are long gold. 75% are short gold. That's interesting here, huh? Well, this is dollar. Sorry, this is dollar. Sorry, I read the wrong one. Hang on, that was confusing. Let me go in here. Okay, 60% of institutional traders are long gold. 75, okay, are short gold. Oh, that's interesting, isn't it? It's very interesting. And I would even argue that I don't agree with the institutional investors that probably retail's got it. But anyways, that is the positioning. Although that positioning is falling. There are less and less and less and less bulls on gold on the institutional side. Here's the seasonality. So institutional traders might just be short-term long. So they think gold should be rising based on seasonality. But you score it all up, gold is a sell. Okay? So there's some flatness here in the technicals. But nonetheless, you sell a lower high. Huh? Okay. Okay. Here, let me give you a free report. Come on. Check it out. If you like this type of information before you trade, check it out. Look at that big move on the Dow. Holy smokes. Holy smokes, eh? So let's flip over and look at the stock market. I want to look at the S&P 500 though. Although Dow may be the better performer. Okay, check this out. The initial move in the S&P 500 was down, then a complete reversal up, and now it's almost back to where we started. And it's one of those things where, yeah, that's why I'm basically neutral on everything. Hua? Okay. So I would mark this if I were me. Okay. And there's my area of interest. I'm trying to move it a little higher if I keep a little higher. Okay. And so if you were a bull, that would be your first opportunity. Okay. That would be your first opportunity to consider buying if you're already a bull. Frank says 10-page report. Nice. Yeah, the reports I've been sending out to clients are like 14 and 15 pages long. Because I'm covering like the 10-year T-note and stuff like that. Like, there's a lot. I update people on retail positioning as well as institutional positioning to show you where everyone's long and short. I mean, it's pretty detailed. I mean, it's very detailed. Take care, Johnny. Oh, why is a trend labeled -2? That's analysis. Again, so what the algorithm is doing is pulling in data. It's looking at retail sentiment, institutional sentiment. By sentiment, positioning. It's looking at retail positioning. It's looking at institutional positioning. It's looking at employment, inflation, interest rates, growth. It's looking at seasonality, but it's also looking at technical analysis. So it's analyzing what has happened. Okay, where did I don't have the page again. Did I close it? There we go. Okay, let's go back to something. Pick euro dollar here. Okay. It's looking backwards from today backwards, and it sees that there's, right, an uptrend, there's a higher low based on the amount of days it's looking at. Remember, it's not subjective. It's quantitative. It's just like it's made a higher high, higher low. That's it on that time period. And from there, it's trying to project using technical analysis. Again, it's just math, guys. It's just math. It's not an opinion. And it says here, if what has been happening in the past continues, there's a base case. Okay, base case is the middle. Worst case is the bottom. Best case is the top. So it's saying, based on what has been happening, in the next 7 days, we'll go back to 99 or parity. But the rest of the fundamentals say, I don't know, it might not. It might not. So therefore, you have everything that says sell, 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 sell. Okay? Sell, 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 but technicals are up. Sell, 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 but it's up. So it's like, well, you can sell this, but be cautious. You could sell this, but be cautious. And that's how it's getting there. Okay? And that's the price action it's looking at. And it's like, yeah, soft sell. Because it's a sell, because it fundamentally should fall, but technically it's not falling now. Do you remember the Aussie US dollar trade I showed you at the very beginning? On the daily chart, the daily chart says, based on technical analysis, Aussie dollar will probably fall. Okay? But on the 15-minute chart, it showed that it wasn't falling, it was rising. So what do? You wait. And that's kind of what this is saying, where fundamentally this is a soft sell, but technically it's not a sell at all. So back the truck up. Okay? Back the truck up. So amateurs chase price. Okay? Amateurs chase price. They see this fall, so they start selling. Then they see this rise. Then they start buying. And then they see this fall, and then they start selling again. And they're losing money all over the place. A professional had an order in here yesterday. They're playing the range. And that's that. Do you remember the page you signed up to attend this live stream on FX Street? Remember that page? I don't have the page in front of me. But there's a link on the page, and it says, download Wayne's report on how to prepare for and trade the employment situation report. How to trade NFP. I wrote a whole article on it. I gave 2 or 3 trading strategies of how to trade non-farm payrolls, of which this is one of the strategies. And that's that. Regil says, hey, S&P taking a nosedive. Of course it is. The Fed's going to have to continue raising interest rates. Of course it is. I shorted the S&P 500 yesterday. Again. But I'm not doing it now. I mean, now. You kidding me? Guess I could have. but I was busy doing this. Okay. Okay, so anyways, we're back at right at the neutral price, at the price we were when we began. I think bulls bought it. I think bears sold it. I think they've jammed their stop at break even, and retail traders have lost money. That's how I'd look at that. Oh, what part, Matrix? Mr. Know-it-all? I did. I sold. I sold yesterday. I'm triple leveraged short the S&P 500. I've been triple leveraged short the S&P 500 since, what do you think, July? Frank says, do you ever get a drawdown? It's inevitable. Oh my God. I think it's actually impossible to not have a drawdown. And I'll give you an example. Let's say over the course of 3 months, so 1 quarter, I'm trading, and remember, I'm a trend trader, so I want to stay in trades for weeks. So let's say in the course of 3 months, in month 1, I have 10 trades open. I'll just make up a number. Okay, by the second month, I have 20 trades open. And by the third month, I have 30 trades open. Okay. And at some point here, I hit a target and I exit all 30 trades. So, right? So I might have like something like this. In month 1, I had 1%. In month 2, I had 1%. I wanted to make that 1%. Okay, return for the month. In month 3, I have a 4% return. Very uneven, very skewed. Well, because I'm building up positions and I'm scaling out of some winners. Some of them, the big winners, like I usually get out around 333 or 500 pips, depending, right? But whatever. So some of the winners I cover. So because I have lots of losers in here. Let's say to get 30 winners, you have to have 100 trades. Do you understand that part? Because it's going to explain the next part. Okay. So lots of losers, lots of break evens. They're all small, but I get 10 winners and I let them run for 9 to 12 weeks. Same thing here, same thing here. So, but I exit all 30 and I get a big windfall. So I've produced 6% for the quarter, which is fantastic. And then going into this next month now, especially in the first few weeks, I might be negative. I'll say like -2 because I haven't got my 10 runners yet, my 10 winners. I just have lots of break evens and lots of little losers. So I haven't got this. I only got like 2 winners and 30 mediocre trades or whatever, right? And so for a while it's -2 until I get this into the 10 winners. And the 10 winners gets to the point where it brings it back above to +1 because my winners, let's say, are somewhere between 100 and 500 pips per trade. And my losers are -33 pips. I think after on this coaching account, I think after like 400 example trades, my average loser is 33 pips to the nose. It's either 33 or 25. I mean, the average loser is tiny, and the average winner is like 100 something pips. So I have a 3 or 4 to 1 ratio. My winners are way bigger than my losers. So in the beginning, I might go -2, but by the end of that period or soon thereafter, let's say 6 weeks into the new quarter, now I'm +2. But that's after sort of washing out all the little tiny pissy little losers and all the little break evens. And then I let my winners run. And so inevitable, it's going to go 1, 1, 1, 4, -2. And then by the end of that period, it's back to positive. And then, a little bit win, a little bit win, a big win, a little bit win, a little bit win, bigger win, that kind of stuff. It also has to do with seasonality, the time of year. Which quarter are you talking about? Some quarters have a bigger beta. And if the beta is big, then my alpha will reflect that. I'm not here to outsmart the market. So like, for example, if someone looked at, by beta, what I mean is the overall market, systemic market, the overall market. So if the overall market is down, let's say 10%, and someone looks at your trading and you're plus 55%, just to have an extraordinary difference. Someone is going to say, well, that's interesting, but how did you get it? And this is where risk-adjusted performance analysis comes in. And someone would look at this and say, you got it through gambling. You took a lot of risk to get that reward, and it's a fail. Now contrast that if the market's down 10% and you're plus 10%. You can say, well, because I'm a Forex trader, if the stock market's down, I can buy the dollar. And my alpha would reflect the beta, a 10% move. And it would make sense to an institutional investor. And if I had 40%, they would look at my trades and say, oh, well, you're doing the right thing, but you might have too much leverage for what we would like. And so if we were to have you manage our money, we would want you to lower the leverage so that you more closely reflect the beta. And you're like, oh, I can do that. The trading's the same. You just lower the lot size. And that's because they want lower volatility. So a higher return either comes with more risk, which is bad, or more volatility, which is bad, or usually both, which is really bad. Okay? So that's what drawdowns are about. I don't think you could trade without a drawdown. So there's a couple of things that really stink. Real amateur hour scam artist stuff. One, they have nearly 100% winning percentage. Okay. Two, they make a lot of money. I make 200% a year. Yeah, okay, 200% on $2. Because only a person with no money would gamble. You should know the trader psychology. An institution doesn't want to gamble. A high net worth individual doesn't want to gamble. What's the point of gambling? What's the point of gambling? To make a lot of money. They already have a lot of money. Do you understand? So you have to understand that someone that would want to work with you, they already have money. So if you're going in there like, I want to be a Forex trader so I can get rich, you have already failed yourself. I hope you understand that concept. You've already failed yourself. So I wear skulls. I don't know if you can see that. Let's see. I have to see the camera. Hang on. I got too many windows open. All right. There's the camera. Can you see my skulls? You see them? Oh, look at my bull. You see the bull? That's a bull. All right. You see the skulls? Trying to get you a good angle. It's kind of hard to move my wrist. Skulls. No, they're weird. There we go. They're skulls. Trust me, they're skulls. There you go. Okay. Ciao. Nice, right? All right. It has to do with stoicism. And you have to imagine the emperor of Rome is the richest person in the world. Marcus Aurelius could tell you that wealth does not bring you happiness. Wealth does not bring you happiness. So look at this. I'll show you that. Some of you guys like watches. Look at that watch. Huh? Can you see that? Oh, you can't quite see it. That's a nice watch. Custom made. There's not even a brand on it. Sorry. It's hard. There's a bit of a lag I can't see with the camera. Does it make me happy? No. Oh, look, I have another watch right here. Look, there's my Panerai. Does that make me happy? Hey, dude, it's a freaking nice watch. It's all ceramic and everything. Even the pins. See, it actually brings me pain. These pins on my Panerai are ceramic pins, and they come loose, and I've lost the little tool, and I can't get them back in, and therefore they scrape my skin. So my Panerai doesn't bring me pleasure, it brings me pain. And they're too heavy. Oh, well, I got a certain level of wealth. Doesn't make me happy per se. It makes me comfortable. Oh, I wouldn't want to be poor for crying out loud. But so what was Marcus Aurelius talking about more than 2,000 years ago? The richest person in the world. He said, his wealth doesn't make him happy. It came with a lot of responsibility. It was a pain in the butt to be emperor. He didn't want to be emperor. So what did the Stoics say about the secret to life? If money doesn't make you happy, well, what can bring joy and self-fulfillment? And it's discipline, it's work ethic, it's modesty, service, family and loved ones. So when someone says, I want to become a Forex trader to get rich, they've already done themselves a disservice. First of all, you're not going to be able to provide the value that a customer would expect. Because you're focused on you making money and they're focused on other things like, hey, Richard, I have a portfolio of assets, all kinds of assets that are a store of value of my net worth and are trying to provide an income and asset appreciation above the level of inflation. I'm just trying to stay rich because I ain't going back to the ghetto. It's too hard to go rich back to poor. I mean, look, that's a fear. That's a fear. Someone that already drives Lambos and has mansions and flies on private jet planes and visits the exotic places on earth. Their fear is one day they won't be able to do it again. They're already rich. So if they're going to hire you, they're like, hey man, I want you to keep me rich. I need income to put gas in the yacht. Okay, great. Fine. But do not, under any circumstance, gamble my money. Just get me my 15% a year and I'll be happy. Because after I pay you, I've beaten inflation, I got income, I'll live on the income. Don't worry about it. My assets will appreciate. My houses will go up in value. My stock portfolio will go up in value. The bond portfolio will go up in value or provide income as well. My real estate holdings, they're going to go up in value and provide income. They're in all these private deals. They're invested in venture capitalists. They got a lot going on and all that kind of stuff. And you're the Forex dude. And what they don't want from you is a 40% drawdown. They don't want you to try to make a bunch of money and get rich quick. But that's how you're thinking. And by the way, when you show up and that's what you talk about, you stink and reek of poverty. And it scares the bejesus out of a rich person. A high net worth individual will just run for the hills because you're talking a poor man's game. Hey, you want to get rich quick? Dude, I'm already rich. What the hell are you talking about? Sounds like you want to get rich with my money. Okay? So anyways, I want you to turn it around and think about like what Marcus Aurelius would have told you in the time of the Stoics. That you should just love being a currency trader. You should enjoy doing the research. You should enjoy the intellectual challenges of making decisions. You should enjoy explaining your theories and your process with your clients so that they can feel comfortable and be informed about what you are doing with their net worth. You should really enjoy that. It should be a highlight. Now, I know financial managers that avoid calling their clients. That's the worst case scenario where, God forbid, the phone rings and it's a client. Hey, Sally, who's that? Oh, it's your client on the phone. Tell him I'm out of the office today, right? Oh my God, I don't want to talk to that guy. The stock market's falling. I don't want to talk to this guy. Oh my God. That's what a financial advisor does. Instead, you should be calling them proactively, calling your clients or having network events or meeting with them to talk about what's going on, why it's going on, things you have done, things that you're going to do. It should be a pride and joy of what you do. And because you spend so much time thinking and researching and pondering and coming up with plans and challenging yourself and you enjoy doing it, first of all, you're really good. But second of all, you are creating an amazing amount of value through good trading, world-class customer service with white glove treatment. And I'm telling you, you're bringing happiness or joy or maybe simply comfort to your clients, but you're bringing happiness and joy to yourself. And this, my friend, will provide you with more wealth than you can imagine. But precisely because you were not trying to get rich, you will get rich. Do you know how the secret of getting rich is providing way, way, way more value than you charge? Do you understand that? It's the secret to success in anything. So I would recommend to a younger trader to spend as much time possible finding ways to create value. And in the beginning, you're going to need to focus on world-class education, so that not only can you do better at planning your trades with better strategies, but you can explain why to your future customers and clients. Okay? It's about creating value over long periods of time. Hey, where's that little fabric to clean my glasses? Oh, it's gone somewhere. Oh, there it is. Rajit says that would be a loss for you. Okay, I spent hundreds of thousands of dollars at Harvard. You could spend $88 and probably learn almost everything I learned at Harvard. I can't make it cheaper. I'm sorry. I used to charge $1,000. But check this out. When COVID hit and people were locked at home, I lowered the price from $1,000 to $88, as I considered it as a public service to our community. If you were going to be locked at home, I don't want you to be meme stalking your way to riches. I'd rather you spend the time learning. So that's what I did. Not going to get rich though, huh? Sorry, I'm cleaning my glasses. They're terrible. Cool. So anyway, look at up and down, turning around. Bitcoin's still not really doing anything. All right, so let us, how about this? I'm going to take requests. Do you have a request? How can I help you? What currency pair or asset class would you like me to cover? And I'll do some analysis with you. We'll keep it technical. WTI can do that. By the way, did everybody get their free QuantBox report? Did you do it? It's last chance. We're going to be done in 20 minutes. Last chance. Hint, hint, hint. There's also a coupon code in there. Mm-hmm. Ben says, Bitcoin under massive accumulation, manipulation. Whatever. I don't care. Doesn't matter to me. I just don't want to trade it. Euro Aussie. Why Euro Aussie? There's multiple reasons why you'd be trading across. Let's pick on that for a second. Okay, why Euro Aussie? And are you a bull or a bear? While I wait for you to answer that, we'll ask the algorithm. Hey, Algo, what do you think? Well, interest rates favor Australia. Unemployment favors Australia. Inflation favors Australia. GDP growth favors Australia. But there's a slight bias on the trend to euro. Seasonality is -1. COT data slightly favors euro. For example, 60% of institutional investors are long euro, but only 30% are long Aussie. So that's where you get that number. And so it's a soft sell. So we can go there and look at Euro Aussie soft sell. Okay. Okay, Euro Aussie soft sell. So let's go there. Euro Aussie. Okay. And so you can see it's been very much an uptrend. But Euro Aussie, okay, Euro Aussie has been a downtrade since the top of October. You'll see in October, if I can get my drawing tool, we topped out. Okay, lower low, lower high, sell, lower low, lower high, sell, lower low. What do you think I'm going to do next week? By the way, welcome to the person that just signed up for QuantBox. You can log in right now. What do you think I'm going to do next week? Sell a lower high. Oh, God, as Kanye would say, huh? Yeah. Because it fundamentally makes sense and is technically valid. Okay? That's euro dollar. Huh? Do you like that for a level of clarity? Do you like that level of clarity? Adding quantitative analysis to your trading should bring you consistency and might actually give you confidence to stay in your trades more than 20 pips. A 20 pip winner is pathetic. Okay? You should have trades that are 3, 4, 500 pip winners. And if you've never done that before, it's because you never knew. It's not your fault. You've been spending your days scalping. Okay? What's the problem with scalping? Scale. You can never, ever, ever scale as a scalper. You essentially get paid for your time. You sit in front of your charts for 10 hours a day, which sucks, by the way. I can make one trade, walk away, and come back in 3 weeks. And I'm like, dude, I spent 5 minutes on this trade. And then 5 minutes the next day, I moved my stop to break even 24 hours later. Then I come back 3 weeks later and I'm still in the trade. I haven't done any work and made money. Whereas scalper has to make a bunch of trades. Many of them are losers, many of them winners. And at the end, you work really, really, really hard and you've made some income. Okay? Poor people are paid income. Do you understand that? Do you get that concept? If you get paid for your time, you have a job, by definition, you're trapped in poverty. It's not your fault. I'm not belittling you. But you're getting paid for your time, which means your time is worth less than someone else's time. They're like, you're going to work for me, and there you go. Now make me rich. The difference, so scalping, taking some trades, you're in a bunch of trades today, you're out a bunch of trades today. And at the end of the day, you have nothing. Now, you might have earned some money, you might have lost some money, but at the end of the day, you're back to nothing. There's no growth. You're never getting big. You're perpetually small, picking up peanuts and grinding an organ all day for picking up peanuts to get free peanuts. It's really hard work and it doesn't make much money. So eventually what'll happen is you decide to bet bigger, have bigger lot sizes so you can make real money. And that's when you blow up your account. And then you decide to take a real estate investing course. You're going to flip houses and get rich that way. Then that doesn't work. Then you decide you want to take an options trading course. And, well, that doesn't work. And then you go try something else. So the secret to all investing, by the way, is scale. And what that means is how can you get a trade and let it run for weeks? Meanwhile, over the course of time, you add another trade that will last weeks. And then you add another trade that will last weeks. And another one, and another one, and another one. The only way to get big and make a lot of money in the financial markets is letting your winners run and then getting more winners. You're always spending your time setting up new winners. You're not chasing price. You're waiting for price. And then you have the confidence and fortitude to stay in the trade because you spend a lot of time planning and analyzing. You know it's going to work, or at least you think you know. You take the trade, you have the patience to let it set up properly. You have the patience to not jam your stop too quickly. You're not concerned about losing money. Why would you be concerned about losing money? You spent all this time setting it up. So when you're in the trade, it takes a day or two for it to get going. So hopefully within 24 hours, you're able to move your stop to break even or close to it, or at least closer. And a day or two or three later, you certainly don't have risk anymore. And you let that run. And all the pissy little losers, they get wiped out. It's not a big deal. But you get another one, let it run. Get another one, let it run. Have you ever had 10 trades open at one time with more than 100 pips? Profit per trade? Have you ever looked and seen 1,000 pips in floating profit? If you've never done that, you're not trading properly. I don't think it's your fault. That's not sexy. It's not what sells. What sells is in and out, in and out, in and out. Look at all these trades, in and out, in and out. I made 5 pips and $500. That's the dumbest thing ever. If you ever see someone on YouTube place a trade, make 500 pips in $500 in 5 minutes or 10 minutes, and they're only up 10 or 12 pips, it's the dumbest thing ever. You should laugh for a little bit and then run. There's some sort of song or story the siren is singing to the broke and the desperate. It's terrible. It's the Pied Piper, right? Walking the rats into a death trap. It's not. I'm telling you the opposite. I think many people here are going to be very successful because they have a work ethic and a passion for what they do. The success is just time, and how much success is how much you started with. But many, many people here will be successful because of the work ethic and the passion. You convert that potential energy into value creation, your potential energy into value creation, and you will be successful. Just takes time, and how much depends on how much you started with, because it's just compounding. It's just math. So I'd rather you spend time falling in love with the process of becoming a master. You cannot get a black belt until you've done all the classes, you've passed all the tests, and now you are proven an expert, but you're not a master. To become a master and to get your black belt, you must teach. You must teach how to make a fist, how to stand with balance, and be a role model. Ha! 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 Nope. Elbow in, elbow in. Nope, nope, nope. Take the thumb out, put the thumb here. And after doing that, you have become a master. You cannot become a master without that level of passion and discipline and focus and drive and love. Because you're like, well, Wayne, I don't want to be a YouTube guru. That's not what I'm talking about. At some point, you will manage other people's money. Okay, maybe it's your husband's money, maybe it's your wife's, maybe it's your mom's, maybe it's your dad's. You're like, no, I don't want to be a professional trader, but, I have to look after my family's money. Look, that's OPM, man. You're an opium trader. That's other people's money. Where you should be able to instead sit and talk with someone and explain what you're doing, why you're doing it, and why that's an appropriate strategy. You know why you're doing what you're doing. You don't open your charts to find a trade. That's the path to poverty. That's the poverty trap. You only see this much of the world. You're the frog in the well that knows everything. You are a frog staring up at the blue sky, and he thinks he sees the entire world. And he's an expert. Oh, there's so much more. And it's beautiful. And it's wonderful. And if you do it right and you focus on the right things, it will bring you self-worth and comfort, pride and joy. Put a little skip in your step. How rich are you going to get? What's the point of that? What do you mean how rich? The rich isn't going to make you happy. In fact, you walking down, okay, you being lured off the righteous path is going to lead to your self-destruction. And you will never generate the wealth that you seek. And even if you did, it's not going to bring you happiness, and you're going to do something stupid and blow it up, and it's all going to disappear. The only way to wealth is creating value and giving that value away for less than it cost you, really, if you think about it. Which is another way to say you add positive energy to the universe. You make the world a better place. You keep rich people rich, and they appreciate you for it. You combat poverty. You're anti-poverty. It's not about rich. It's about making a difference in the world. And you can do this. And the interesting thing, going back to the Stoics, they'll tell you that people that do this, and it doesn't matter what walk of life, what you do for work, whether you're a currency trader or a carpenter or a landscaper or a fisherman or a teacher, you will get riches and rewards beyond belief, beyond your wildest dreams. Because you are serving and you are creating value. And you're loving it every minute of the way. And I'll tell you what, people will flock to you. And you will be more than compensated. Because you make the world a better place. Trust me, that's the secret to success. Especially as a currency trader. So think a little bit bigger. Get to know fundamentals, get better at technical analysis, deal with some of the trader psychology issues. It's all been explained here at FX Street. There's been thousands and thousands and thousands and thousands of webinars and videos done by experts of all kinds. I mean, this is my 199th monthly webinar. So FX Street is full of resources. I have something like 5,000 or 6,000 videos on YouTube that are all free. Watch every single one of them. Doesn't cost you a penny. If you have a little bit of money and you want to get on with it, join FX Bootcamp. Speed things up. Why waste another 2 or 3 years trying to figure it out on your own, or listening to a bunch of kids on YouTube preach their yellow Lambos and girls in bikinis? Just move on. Start working with an adult. Start getting proper mentorship and guidance. It's $88 a year. That's it. If you need a broker you trust, an ECN that just takes your trade, boom, pops it into the interbanking system with fast execution speed, because they're straight through, man. They're faster than almost every broker out there, because they put your trade straight in the interbanking system. That's tradersway.com. Straight through processing, ECN. Boom, you're in the market. When the Swiss National Bank lied to everybody and then pulled the plug on their peg, major brokers around the world went out of business the next day because they were holding all the losing trades because they were trading against their clients. Do you understand that? Major, huge brokers lost hundreds of millions of dollars overnight. The tide went out and they were standing there naked and went out of business because they were trading against their clients. If you want to avoid, you're like, dude, I wonder if my broker's trading against me. I wonder if I'm B-booked. Well, just move over to tradersway.com. It's an ECN. There's no B-booking. There's no A-booking. There's just, dude, you're in the interbanking system. Tradersway.com. Lots of resources, lots of stuff. Thank you to FX Street. They're amazing. Thank you, FX Street. Thank you to our moderator. But also let me thank you guys. Thank you for being here. You spent another 3 hours with me. I appreciate your time. I know it's valuable. You had lots of choices. You're a busy person. So I hope you received your return on investment. I hope it was worth it. So thank you. And don't forget to click the thumbs up button. Again, to show some respect to our host today. Tell YouTube that FX Street has good content. And I will see you on Sunday if you're in my live swing trading group. Day trading group. I will see you Sunday afternoon if you're in my day trading group, because we front run the day, of course. We trade before, not after. And then if you're any member of FX Bootcamp, video only, day trading, swing trading group, it doesn't matter. Every single member of FX Bootcamp, you will be invited to join my live coverage of the election Tuesday night. Make sure you order some pizza and get some beers. And we're going to have fun that night. And by Wednesday, we should be in our long-term trades. That's the plan. So, from the bottom of my heart, let me end by saying this. Peace on earth. May the pips be with you. May your profits be above average.